Hi there. In this topic video, we're going to take a look at the concept of capacity. Now, business capacity is a really widely used concept. It's important to understand what it tries to achieve, what it tries to measure. Capacity is a measure of output. It's a measure of how much a business can produce or sell or achieve over a given period. And capacity can be measured in lots of different ways in a business. For example, it could be measured in terms of how many customers per hour or per day could be served, perhaps in a fast food outlet. It can also measure the number of interactions with customers. For example, the capacity of a call center might be measured in terms of how many customer calls can be handled each day or each week. Of course, in the business of sport, stadium have a fixed capacity, and therefore capacity is how many fans can be seated at each event. Similarly, a cinema chain has a fixed number of seats in each of its screens, but its capacity is how many of those seats could be filled over a particular period. And of course, we should be familiar with manufacturing capacity in particular. For example, an example here of the car production line. How many cars could be completed over a certain period? So capacity is a really important measure of operational capability. It's how much can a business produce over a given period. Capacity is also, importantly, a dynamic concept. Capacity changes. For example, if you've got a production line and you have to repair or maintain or replace a machine, that reduces how much that production line can make whilst that maintenance or repair is being carried out. Similarly, if capacity, how much you can make, is linked to how many people you have in the business, your capacity may be affected by how many turn up to work or how many production shifts that you run each day or each week. Capacity also needs to be dynamic in the sense that it needs to be flexible. Many businesses need to be able to flex or change their capacity to take account of unexpected changes. For example, a significantly seasonal demand in a business you'd want capacity that's flexible. And of course, also picking up on unexpected changes in demand. It's important to be able to add to capacity. So key points so far, therefore capacity is a measure of output, it's a measure of capability, but it's also a dynamic concept. Capacity can be and sometimes needs to be changed. Now, another important concept, capacity utilization, and there's a clue in the term. The utilization of capacity is how much capacity is used over a particular period. And we calculate this as a percentage. We calculate the percentage of the actual capacity that's being used. Here's a little example of how we calculate it using this formula. We take the actual level of output, always in units, divide it by the capacity, the maximum possible output, also in units. And of course, to get to a percentage, we need to multiply that number by 100. Let's have a look at an example. In this case, we've got a printed circuit board manufacturer, the stuff that goes in so many electronic devices. This factory has the capacity, is capable of producing 500,000 circuit boards per month, 500,000 per month. That's our capacity. Last month, we're told actual output was 340,000 units. What was the capacity utilization? Well, if you want to have a go, pause the video. It's quite a simple calculation using that formula. We take the actual output of 340, divide it by the capacity of 500,000 and multiply by 100. In this case, that would be 0.68 times 100 or 68%. Now, in a separate revision video, we are looking at how you could calculate capacity utilization in 2 or 3 other different ways, but that's the classic way. Now, you might be asking, well, why are we bothering to look at things like capacity utilization? Well, the key line of analysis here is that capacity utilization is very closely linked to the concept of productive efficiency, and therefore it's also very closely linked to the concept of competitiveness. If you imagine, capacity is a measure, isn't it, of how much resource we've got invested in the business. And if the utilization or use of those resources is low, in other words, it has a low percentage utilization, that might be a suggestion that we've either got too much invested in the business or the business is being inefficient. It's got idle, unused resources. And as a general rule, lower utilization tends to result in higher unit costs because a lot of those resources are fixed costs. So generally, businesses try to operate at as close as possible to full capacity as a way of minimizing their unit costs. And of course, that's particularly important for businesses that have high fixed costs, because if you remember from your break-even analysis, if a business has high fixed costs, it's important to try to achieve the high break-even output. And capacity utilization, of course, is going to be fundamental to achieving that. Now, capacity has cost. We've talked about fixed costs here. If you think about capacity, it's the way the business enables itself to produce units. So it's the costs that are involved in making capacity possible. So it's definitely things like production line equipment or facilities, isn't it? Equipment, facilities, machines, and the buildings in which those machines and facilities and services are housed. But of course also that a significant cost of capacity is labour, particularly for labour intensive businesses where output is largely determined by how many people you've got in the business and by how skilled and productive they are. So capacity is very closely linked to the costs of a business. So why, you might ask, would a business not operate at full capacity for as long as it can? Well, the answer is there are lots of different reasons why it's not possible to operate at full or 100% utilization. Firstly, of course, it might just be that demand is lower than you expect. So you've got a factory that can sell 100,000 units, but demand is only 50,000 units. Well, there's no point running the factory producing 100,000 if the demand isn't there. So lower than expected market demand can reduce capacity utilization. And of course, that might also be a symptom of a loss of market share. Maybe you used to be the market leader with a large factory that was very busy. You lose market share, all of a sudden the large factory is still there, but you're not so busy. We've also mentioned, of course, there can be these seasonal variations in demand that can affect utilization from month to month or week to week. And of course, it could be that actually there's been a recent increase in capacity, but not yet an increase in demand. And that would be a reason why utilization is less than 100%. But of course, generally, you can't really achieve 100% because of the need to maintain and repair your capacity. There's always going to be some parts of it that just needs fixing or repairing or maintaining. Quick bit of evaluation to finish off. A classic question might ask you to consider the risks or dangers of operating at low capacity utilization. What might the implications of that be? Well, I think we've already hinted at this, haven't we? Which is that low capacity utilization, particularly for a business with high fixed costs, is really bad news because it implies that the business is going to have higher unit costs than the competition. And if you've got high unit costs than the competition, that's usually a sign that you're lacking competitiveness. We've also mentioned break even. So if capacity utilization is low and fixed costs are high, it means that you're less likely to get to that break even output at which your fixed costs are covered. And of course, the other big cash flow reason and return on capital reason why you shouldn't operate for a long time at low capacity utilization is that you've got so much capital tied up in capacity, in fixed assets and factories and plant. If you're not using it, that's a waste of the shareholders' money. However, there are some potential problems of trying to push utilization as high as you can get it. How close can you get? Can you even get over 100%? I guess in certain circumstances it's just about possible. One of the issues, of course, is it could be that you're pushing so hard that quality suffers. There's less time to check that the quality is good. And of course, don't forget the poor old employees in a labor-intensive business operating at very high levels of capacity utilization. There's a risk of overworked employees, increased stress, which of course over time can become pretty demotivating and demoralizing. And of course, the other issue with working at high capacity utilization is that you're less able to deal with sudden or unexpected increases in demand. So there we go, guys. That's been an introduction to the concept of capacity. And I guess the key points there are that capacity is a measure of the output of the business. The key calculation is that utilization. How much of that capacity are we using? And is that good or bad for the business?